Hey everyone, I'm Paul Moore with Bigger Pockets and Wellings Capital, and I'm coming to you from my studio here in the heart of Lynchburg, Virginia. I'm looking out the window at the lake and a beautiful sunny day, and I hope you are having a great day wherever you are as well. Speaking of you, where are you? Who are you? Tell us who you are, where you are, what you do. We'd love to hear from you. And if this information is helpful to you, and please leave us a thumbs up, a like, or share this. We would love for Facebook and YouTube to know that this information is valuable to you. I know that I, for one, appreciate you. My company, Wellings Capital, we are so thrilled to have the opportunity to do this, and so grateful to Bigger Pockets, so grateful to Nikki Frick and the whole team at Bigger Pockets. Hey, Matt Norden. Hey, Anthony Duckery from Maryland. Okay, so we're glad you're joining. We got folks joining from Bigger Pockets Live, YouTube Live, Facebook Live. Today, we're going to talk about Crisis Investing 101 again. Why crisis investors love mobile home parks. So there's lots of reasons that crisis investors and other investors love mobile home parks. They've had a stigma for years, but that stigma is quickly evaporating as people realize that mobile home parks will be one of the last people standing in this crisis. So hello, Cynthia from Durham, North Carolina, not far from me. Hey, Kathy from Huntsville. Hey, Kathy from Seattle, just rising, sun just rising there. Hey, Anthony from LA, Joel. You love mobile home parks too. Thumbs up for that. So we're going to talk today about why crisis investors love mobile home parks. So Nikki is going to put up the first slide, and we're going to be talking about this topic today. Now, I want you to know that, first of all, before we get into that, we are not going to skip our Fear and Greed Index. So the Fear and Greed Index is a 7-part index. It's based on 7 different things going on, including bond trading, stock trading. This is generally a stock market type thing, but it's a indicator of today's fear and greed numbers. So January 17th, look at that, extreme greed. But look at this, March 6th. What's that, 6 weeks later, 7 weeks later? We've got a fear and greed index of 6, extreme fear. Today, actually yesterday, the index was tracking at 43. So 43, meaning people are still fearful, but they're kind of tending toward optimism. Now, real estate investors, that's you, that's me, we don't have to go with the whim of every up and down market. We don't have to panic every time there's bad news or a conspiracy theory or somebody else getting sick. We can tend to be counter-cyclical. And that's what I'm hoping to accomplish in Crisis Investing 101. This news came out yesterday too as well. CBRE confirmed that the April job market was really bad news. 20.5 million jobs lost, a little less than they predicted. 21.4 million jobs lost since March. Unemployment rate skyrocketed to 14.7%. And 78% of these people were reported as temporary furloughed. But honestly, I'm hearing that a lot more people are going to be laid off permanently than planned before. This could be the best time of your life, whether you're laid off or not, to be getting trained, getting your team, getting your tribe together for real estate. So that's sort of a breakdown of what's happening out there in the different sectors. Retail is obviously taking a massive, massive hit. And it already had headwinds against us going into this. So retail is going to continue to do really poorly, I believe. This is a sector GDP COVID sensitivity map. You want to be as far down and to the left as possible. And the winner on this one was medical offices, followed closely by cell towers, self-storage, data centers, manufactured homes, and single family rentals. A lot of you are single family rental folks, and so that's really good news for you. Today, we're going to talk about manufactured housing. But before I do, I want to get into why the wealthiest people in the world love commercial real estate. Now, this is currently the wealthiest man in the world, but we're talking about him today not because of his wealth, but because of his vending machines. What, you say? Well, Jeff Bezos went around the Amazon facilities all around America, probably around the world, and he had the little light bulb removed from the top of the vending machines because he said, well, why do I care about advertising for Lance Snacks or whoever? And he said, furthermore, it's using electricity and it's using a replacement light bulb when it goes out. And there's labor, there's maintenance involved in replacing the light bulb. So I'm just going to take those out. Now, why would Jeff Bezos, the wealthiest man in the world, care about that? He cares about it because he knows that $1 saved per month can magnify into a large amount of wealth for him. So $1, what's the power of $1? Well, the power of $1 a month is $12 a year to their bottom line. $12 a year is magnified by their stock price to earnings ratio. And if that price to earnings ratio is, say, 20 to 1, that's 20 times 12, that's $240 added to his wealth and the wealth of all the Amazon stockholders. So it's a big multiplier effect. Well, commercial real estate's the same way. And I think that's why most of the Forbes 400 wealthiest people in the world invest in commercial real estate. Not to say residential real estate isn't great too, but today we're talking about this. So what about $1 a month added to the bottom line in commercial real estate? Well, that's $12 added to your income per year. And there's a formula. And if you want to have some fun with math today, we're going to do a little math game in a little bit. You're going to want to write this formula down. So grab a pen, grab a scrap piece of paper or the back of that junk mail envelope. And here, let me tell you the formula for commercial real estate. This is going to drive everything else we talk about for the next 15 or 20 minutes. So, and by the way, at the end of 15 or 20 minutes, we're going to do Q&A for the rest of the hour. So value in commercial real estate is the net operating income, the NOI, net operating income, divided by the rate of return or the cap rate. So value is the net operating income divided by the cap rate. So $12 a year added to the income divided by, let's say, a 6% cap rate or the rate of return of that asset is $200 added to the asset value. So I'm saying if a mobile home park or self-storage or apartment operator can save just $1 a month or add $1 a month to their ancillary income, they can add $200 to the value of the asset. This is called forced appreciation, and this is a really big deal. This means that you're not at the whim of comps in the neighborhood. You're not at the whim of the various different people down the street who might get foreclosed on or sell their house for cheaper than you wanted to. You are the captain of your destiny. You can actually drive appreciation. And when you use safe leverage, it even gets better because a $200 increase in asset value with 60% leverage, which is generally considered a moderate amount of leverage, it'll have a 2.5x impact on your equity, meaning that every dollar that you invested will be impacted 2.5 times as much. Now that goes against you too if you're over leveraged in a dropping economy when the net operating income is dropping. So be really careful of over leveraging. And so we love commercial real estate for that reason. Now let's talk about the power of $1 in mobile home park investing. Now, this is where we're going to play some math games. Okay. So remember your value formula. If you didn't write it down, the value is the net operating income divided by the rate of return on the investment or the cap rate. Okay, let's do a few simple examples to talk about why you can force appreciation in mobile home park investing. First of all, let's say you filled 15 vacant lots at $350 a lot. Okay, So that's the monthly lot rent. Let's do the math. I'm going to help you with the first one. So 15 lots times 350 is 5,250 extra a month in income. That's pretty good. But let's multiply that out. That's $63,000 per year because you multiply by 12. Now divide 63,000 by a 6% cap rate. My friends, you just added $1,050,000, $1.05 million to the value of that asset. Now, if that's a 60 lot park and you just filled 15 vacant lots, that's a quarter of the park. You just added $1 million to the value of that park. Now, if you paid a couple $1,000,000 for that park, you might have just added 50% to the value. But for a $2 million park leveraged at 50%, you might only have $1 million in it. My friends, you just double the value of your equity. That's the doubling the value of your investment. You see why I love commercial real estate. But there's more you can do. That's the obvious thing. Let's say you passed water and sewer bills back to the tenants. You saved $40 a month on water and sewer bills, and you did that, let's say, over 125 mobile home park lots. Okay. So can anybody do the math on that? $40 a month times 12 months times 125. That's your net operating income increase. And now you divide that by 0.06. And let's see what kind of increase we get there. Anybody? All right. So that would be, if you assume a 6% cap rate, that would be about $1 million increase. And so $1 million increase in value. Now let's do another one. Let's say you rent 20 sheds and 20 carports each at $25 each. That's 40 times $25. That's $1,000 a month to the bottom line. Doesn't sound like a lot. That's $12,000 a year. That's $200,000 added to your bottom line. Let's say you raise lot rent by a mere 5%. That would be about $15 a month times 300 spaces in a larger park. That's $900,000 added to the value of your park. Let's say on this one, you negotiate a cable and internet deal, $25 a month times 100 lots. Well, that is 25 times 100, which is $2,500. That's $30,000 a year. That equates to $500,000 increased value of the park. You see what I'm talking about? There's lots of ways to drive revenue, and there's lots of ways to drive value in this type of scenario. Now, let's say you spend $100,000 to add paid outdoor storage. Now, this is a real example. A friend of mine bought a mobile home park, and they had 3 or 4 or 5 cars, a boat or an RV parked in front of some of the mobile home parks. Well, they said, hey, we're going to spend $100,000. We're going to pave and fence that vacant acre near the front of the park. They did that, and they said, okay, if you've got an extra 2 or 3 or 4 or 5 cars parked in front of your mobile home or a boat or RV, you've got to park them in here. And they started charging rent on that. And the value of that rent, the total value was $10,000 a month. That's $120,000 per year. Divide 120,000, the net operating income increase, divided by a 0.06 or a 6% cap rate, which is an estimate. That's $2 million increased value. You see why we love commercial real estate, and you see why we love mobile home parks, also known as manufactured housing communities. So what do we love? First of all, we love that they're recession resistant. They're steady in all cycles. Mobile home parks are the bottom rung on the housing ladder. So if you can't afford $300 in lot rent, you might end up under a bridge. And we don't want to see anybody under a bridge. Mobile home parks play a very important role in making sure that people can have affordable housing. It's the only asset class we know of with a shrinking supply and an increasing demand every year. Now, the increased demand comes from the fact that there's an affordable housing crisis. There really is. Did you know 10,000 people, Elaine, turns 65 every day, but 6 out of 10 don't have more than $10,000 saved for retirement. 6 out of 10 have less than $10,000 saved. And I'm here to be sure that that doesn't happen to any of you, because we want to be sure that you have a lot more saved for retirement. And that's why you're here at Bigger Pockets. But those people, some of them have home equity. So they can trade in that home equity for a mobile home park, lot rent, or for a mobile home in a lot, in a on a lot in a park, and they can actually save a significant amount of money. Now, we know somebody whose father was a well-known doctor in California, and he chose to live in a mobile home park after he retired. He didn't have to, and he gave him a lot more freedom, gave him a lot more flexibility, gave him a lot more money every month. And so this is a choice that a lot of people make. There's also high switching costs. Basically, when a tenant comes to a mobile home park, there's a 97% chance that mobile home will never move again. Whether they move or not, that mobile home park usually will retain that mobile home because there's a very high cost to move it down the road. There's also the thing about fragmentation. There's a lot of mom and pop owners. Frank Rolfe, the preeminent trainer in mobile home park investing, says that 40 of the 44,000 mobile home parks in the US are owned by individual owners. These are mom and pops that don't have the knowledge, the money, the time, or the desire to improve their lot, their park, and increase the value. But you know how, because you were here today. There's also it's the lowest capital expense and maintenance expense asset type that we know of. One other thing we like is there's a stigma. The stigma about mobile homes, the fact that most people wouldn't invest in mobile homes. Most people think of people there as trailer trash, which is a term I hate. Most people haven't invested, and most people haven't rushed into this asset class like they have apartments and other operators, other asset types. So we love the fact that there's a stigma. You can take advantage of that stigma. Now, this is a chart comparing the size and the price of mobile homes to single family homes and apartments. The star shows what the average the size of the units is. The star corresponds to the average square feet on the right, but the that's the size on the right. The average monthly rent on the left corresponds to the bar. Look at the average monthly rent for manufactured homes compared to apartments and single family homes. It's an amazing opportunity for people to get a larger size, fit their family in, but not have to pay exorbitant rents. These are the various rents in different places. On the left, you've got the average 2-bedroom apartment. On the right, you've got the average rent on a mobile home park lot. So in California, it's less than half. In Connecticut, apartments are triple a mobile home park lot. And in Virginia, almost 3 times. So I mentioned capital expenses being low. Look at manufactured housing on the right compared to all the other asset classes, topping off with multifamily on the left, which have a 12% CapEx. Trailer park stigma. Now, most people think of trailer parks as like this little baby on the right here. This is not what we're talking about. We're talking about buying into mobile home parks. They might not always look as nice as this one on the left here, but a lot of them, this is what we're talking about investing in. I mentioned earlier that manufactured housing had no dip. That's the top bar. No dip at all in the 2008, 9, 10 recession. Every single other asset class had a dip. That doesn't guarantee this will happen again, but we're expecting great results from manufactured housing. It's by far the top of this list. Self-storage and healthcare are tied for second, by the way, as far as projected returns from these asset classes. There's also a value in aggregation, which means a lot of REITs and large institutional buyers don't want to write a $1 or $2 or $3 million check for these type of assets. They would like a portfolio. So if you can put together a portfolio of manufactured housing communities, mobile home parks, you can maybe find a buyer who would write you a check for, say, $30 or $40 million to buy all of them. So this is a manufactured housing community in Lancaster, Ohio. Yes, I said it right because I'm from Ohio. And this is one we invested in. This is another one in Gillette, Wyoming. This is one we invested in as well. This is one we didn't invest in, but I thought it was a pretty picture. I thought you'd like it. And now I'm going to talk briefly about how to get involved. Now, this is my transition to the Q&A part of our talk today. So I'm not going to dial in deeply on these how to get involved steps. I'm just going to give you some ideas. And if you want to ask any questions, you're about to get an opportunity to do that. So first of all, you can invest directly in a syndication. This is where an operator puts together a large deal and you can put a small chunk of investment into these. Secondly, you can do the same thing. You can find these through a crowdfunding site. There are some websites like CrowdStreet, Fundrise, Realty Mogul, others who allow you to invest through their crowdfunding portal. You can also invest through a diversified fund. There are funds out there that allow you to invest in mobile home parks, self-storage, apartments, etc. That's what I do for a living, by the way. We have a fund. You can also joint venture with an experienced operator. There are several paths to do this. And if you have questions about that, you can ask in the Q&A. You can join a mentoring group and join forces with others. I know there are great mentoring groups in self-storage and apartments. There are less in mobile home parks because it's a less developed industry, but you can put your heads together with others. Maybe you can find a deal, somebody else can bring the money. And I know groups like that out there. You can find one large group on LinkedIn that has 5,000 or 6,000 members right there. So you can also acquire a mobile home park yourself. There are brokers out there. There are about 100 brokers in the US. You can also find off-market deals. I know a guy who is doing off-market deals in mobile home parks. And here's something you shouldn't do. I get questions about this a lot. Build one from the ground up. Trust me, you don't want to do this. Okay, so that was Crisis Investing 101, why crisis investors love mobile home parks. So Nikki, I don't know about you. I think it'd be great if we take some questions. So I really appreciate the opportunity to share my passion for mobile home parks. And if you've got questions on mobile home park investing, self-storage investing, apartment investing, single family homes, investing in anything else or anything else regarding real estate, now is your chance. So make sure to ask any questions you have in the comments section, okay? So Hanson, hey Hanson, I closed on my mobile home park this week. I'm the proud owner of a 50-lot mobile home park. Hanson, great job. I'm really happy for you, and I'm glad you're here. And would love to hear where that is, and love to hear how you pulled it off, how you found it, and how you pulled together the money to do that. So happy for you, really. Glad you're here. Leandri says, hi, Nancy, we're under contract for a home in Clearwater. So I've talked for weeks in a row about my dear wife, Elaine, and I are looking forward to buying a vacation condo in Sanibel Island or Fort Myers during this crisis. I think there's going to be opportunities like we've never seen before. If 2008 is a foreshadowing, trust me, there's going to be other opportunities in the sand states like Arizona, Nevada, California, and Florida. AI says, Paul, is there a way to estimate management fee per mobile home? Is it similar to single family rentals, 8 to 10%? Just an estimate. Great question. So we believe that the total, if you have city water and sewer, which is the ideal for a mobile home park, you can guess that your total cost to manage a park will be about 30%. And if you have septic and private water through a well, and especially if you're paying for that as the operator, you can guess that your cost will be about 40%. to manage that park. That's total cost. As far as paying a manager, you should probably plan to give them free lot rent and about $5 or $10 per lot per month. And so that would be just a specific cost of a manager. There's typically not management firms that run these, though there are a few out there, and I don't actually know who they are. So El Exito NT says, what do you think about Tampa, Florida? Well, like I say every week on here, Florida has had the biggest ups and the lowest downs in real estate investing, especially, single family, but also multifamily and other arenas. If you can be patient about 12 to 24 months, possibly 36, I predict you're going to find very, very good deals around Tampa, Florida. And so I'm looking forward to finding some myself. Like I said, Orange Juice, welcome back. You said not to build mobile home parks from the ground up. Is it mostly due to difficulty zoning or simply lower ROI? It's both. So NIMBYism is a word you might never have heard before. NIMBYism means not in my backyard-ism. So lots of people don't want a mobile home park in their neighborhood. And so you want to be in places where they don't want one. Hope that makes sense. Anyway, you want to be in places where there's a large thriving population, but it's hard to get there. If you can get in, you've got another large hurdle. And that second hurdle is you have to bring in individual mobile homes or have them brought in. It's typically a very, very slow process. It's not like self-storage or an apartment where you can quickly lease up all the vacant units. It's very slow. It could take you 10, even 15 years to fill up a 100-lot park. And I think that's like the only disadvantage I can think of in the mobile home park arena, at least. I don't know any basically like around 10, Frank Rolfe says around 10 are built in America every year, and they're often rural. I was in the midst of a large building boom in North Dakota in 2011 through 15, and we barely saw, even then, any parks being built from the ground up. RV parks, yes. Mobile home parks, not so much. So Strong Influence Agency, welcome, says, are there any costs that you would face in investing in a mobile home park in a state that may have harsher winters or weather conditions? I'm guessing a mobile home park may have unique repairs and CapEx. So, important point, you don't want to be the owner of the mobile homes. That's one of the reasons the CapEx and maintenance is so low, because professional operators almost always make sure all that is shoved back to the tenants. And another beautiful thing about that I didn't mention earlier is the tenants are now they're joint venture partners with you, because they own the home, you own the lot. It's not like an apartment where you own everything and they can trash it and leave. If they trash it, they're trashing their own place. Sure, that happens. Of course it does. But they're responsible for it themselves. And so your CapEx and the heat and electricity and the water and sewer typically those are the responsibility of the tenant in a well-run park. Now, that said, yes, I think there are some additional expenses with water lines and other things in a way north state. I'm actually looking at a mobile home park in Alaska right now, and I'm wondering about that myself. So great question. I think the answer is yes. Gina says, how easy is it to get finance for a mobile home park? Gina, the financing options are phenomenal. Local banks, credit unions, larger regional banks, they're actually clamoring to finance mobile home parks because they can see there's a large margin of safety, especially when acquired from a mom and pop operator. Charlatine says, what do you think about the market? Should I wait for 2021 for a better opportunity? Yeah. I really believe, so Dave Steck is a guy I admire a lot. I've quoted him a lot on here. He said, just go ahead and write off 2020 and start looking at 2021. Now, if you're a seller, you might want to consider selling soon, like next week. But if you're a buyer, I think the best opportunities, if you look at past crises, are going to come in approximately 12 to 36 months. Last time 2008 hit, 2008 crisis started in 2006. People think it hit the bottom in 2008 or 9. It didn't actually hit bottom for real estate, my friends, until first quarter of 2012. Think about that. That's 5-6 years almost after the crisis started, and 3 years after stock market hit their bottom in March 2009. So Damn S says, any opinion on senior multifamily rental? Yes, I actually think that senior housing has gotten a bad rap during this COVID crisis. I think it's very much temporary. And multifamily, those are like separate condos for each senior. So you've got skilled nursing facilities. That's the highest level of care before you go into a hospital. Then you've got assisted living below that. That's a medium level of care. And then you've got senior housing, which my friend, I've got a friend named Mike Osteroff who just quit his corporate attorney job to work in this exact thing, Dan. So I would say that it is a great place to be as long as you've done a very, very careful market study on the supply and the demand in the market. It's very, very important that you get that right. And there are people out there who will do those studies for you. It's about $5,000. So Laura, welcome. Is it more challenging to get lending on a mobile home park? Do you have to put more money down? Here's a little secret, Laura. Mobile home park owners remember the day when there was no financing, before Sam Zell was the most famous real estate investor in the world. By the way, he has 158,000 mobile home park lots. He and Warren Buffett together are both the two most admired investors in America, possibly the world, and they both are deeply involved in mobile homes or mobile home parks. Of course, Warren Buffett has 21st Mortgage, which finances mobile homes, in answer to your question. And of course, he also owns Clayton Homes, which is the largest mobile home builder. Is it more challenging to get lending? No. For the park itself, sure, it might be more challenging than a single family home or a duplex because it's larger and they're going to want to see that you have some experience. But the little secret here is mobile home park owners still believe what they believed in the 70s and 80s, and that is there's no bank that'll touch these. Therefore, they're far more likely than most to do owner financing. That's right. It's the best asset type that I know of where you can find owner financing. And so that's one route you should look at, Laura. You can certainly look at banks as well. So Anthony's back. Hey, Anthony from Los Angeles, $750K to $1 million to invest. Where's the best place to buy a mobile home or self-storage? Well, Anthony, one way into this, congratulations, by the way. One way into this is to joint venture with somebody else. And I highly recommend, if you're new at this, that you joint venture with somebody else. Put your money together with someone else's. Find a great operator to run it. Find a friend. And I wouldn't put it all in one place. That's just me. But if you have to, sometimes you have to if you're going for these larger investments. I would recommend that you join the LinkedIn group. I also have a friend named Tim Henderson. Tim Henderson is here on Bigger Pockets, and Tim has some off-market mobile home parks he knows about. I also have a friend named James McAndrew who has some off-market self-storage. You can look those guys up on Bigger Pockets and connect with them. There's all kinds of brokers that have these as well. And you can also join a mentoring group, like I mentioned earlier, in either one of those asset classes, and you can cross-pollinate with other members, and maybe you can bring the money, they can bring the deal, etc. Anthony. So hope that helped. Echo de Juscas says, how much down for mobile home parks? It's really hard to say. I wouldn't recommend getting a loan for over 60%. I'm just sort of conservative anyway. So in that case, you'd need 40% down. Sometimes you can get a bank loan for 60%. You can bring, say, 20% of your own money, and then you can get really good owner financing for the other 20%. Now, that's more risky than I would want to do, but a lot of people do deals like that. You definitely want to have skin in the game. Trust me. Hey, Mark Brogan, welcome back. We live in a park. You live in a park? Near Roanoke, Virginia. A mobile home park. The park owner is having many issues with well and septics where they don't do preventative maintenance. Would you buy a park not on city water and sewer because of this? So, Mark, I'm near Roanoke as well. So, hi. And hope you're safe and healthy like everybody else on here. Mark, I would actually say that if you could get it connected to city water and sewer, that would be a huge win. And so if you absolutely can't, there are buyers who will buy those parks, but there's a lot of issues. I mean, I just heard the other day about like a $200,000 repair that was needed on a lagoon septic system. So Mark, feel free to reach out to me. I wouldn't mind hearing more about the park. I don't know if they're actually planning to sell the park, but I know somebody in Roanoke who might be interested in buying a park like that. Maybe you would want to partner with them. You bring the deal, they bring the money, etc. So that's a great way to go. So Trevor, hey Trevor, congratulations on your graduation there. Opinion on online tax sale auctions and best strategies for percentage ownership bidding. So my friends, every week I don't have a good answer for something. So I could blab on and on about an answer on online tax sale auctions, but I wouldn't have a great answer. So if anybody else here has a better answer, I would love for you to comment to Trevor. Now I've done a lot of tax sale, actually foreclosure sale auctions, like at the courthouse steps. As far as online tax sales, I'm not as familiar with that. I understand that if you can get in at the right time, and by the way, the right time is going to be in the next 12 to 24 months as prices are dropping like a rock, you could get an extremely good deal on a tax sale. I mean, foreclosures typically go for 60 to 80% of their value, but tax sales can go. I mean, I heard of a tax sale where a guy lost his home to a foreclosure in Southfield, Michigan. I think he owed $8.51, Elaine. Can you believe that? So $8 he owed, but I mean, it triggered a tax sale and he had moved and the mail hadn't been forwarded. And, it just automatically went to a tax sale and he lost his home. He lost like $100,000 in equity. It was a rental home, obviously. So obviously I didn't give a great answer there. Maybe somebody else will. Joel, hey Joel, is it wise to use a corporate EIA or use our personal social security number, EIN you meant, sure. And go the sole proprietor route. Joel, if you're just doing one or two assets, a lot of attorneys will admit to you that you probably don't need a corporate EIN, that you can just put them in your own name. So my son's a real estate investor and he put a lot of properties in his own name and it went fine. But when he upgraded to more of a professional level, he went ahead and spent, I don't know, $1,500 getting an LLC, and he started putting a handful of properties in each LLC. So sure, it's slightly wiser. It's wiser to do that. Attorneys will admit, I think, that a few properties in your personal name isn't the end of the world. And you can actually transition them easily from your personal social security number to an EIN later if you get a corporation. So strong influence agency, what is the LinkedIn group? I think you just need to search mobile home park owners. So I hope that helps. I don't actually have the name of the group. You can actually look up a guy named Jefferson Lilly. Jefferson Lilly's a friend of mine near San Francisco, and he said he actually runs that LinkedIn group. So Jefferson Lilly on LinkedIn. Justin Kerstetter, thank you for joining. Beautiful picture in the background there. Looks like mountains. I know you've said that you have a daughter going to Bethel. What do you think about the market in Redding, California? Well, I'll tell you, Justin, I do have a daughter at Bethel and Redding, California. And, Shasta County was the only county on the West Coast in a recent review in the bottom 50 of economies resulting from the COVID-19. They ranked all the largest counties in America. They didn't rank every one, but Texas had 10 in the top 50 that would do the best after the recession. New Jersey had over a dozen that would do the worst after the recession, as a result of the recession. Florida had about 10. Florida and New Jersey had like the largest number of ones that would do bad. But in the whole Western US, there were only 2 counties in the bottom 50, and Shasta County, where Redding is one of them. I also know a guy who owns a lot of mobile home parks in Shasta County, and I just talked to him Tuesday last week. And in the Redding area, he said they're doing great. Now think about that. If the economy's doing bad and the mobile home parks are doing great, that should tell you something. Another reason I love mobile home park investing, especially going into a receding economy, which many of us believe we're going to have on our hands. So Justin, thank you for the question. Great question. Michelle Walters says, I came across a mobile home portfolio listed in Ohio. One of them is local in my area. I only have single family homes, and I can't wrap my head around transitioning to manufactured housing. Been following you and trying to determine exactly how to execute. How do you pull this off without partnering? Or is it just not possible while so small with my current 5 single family homes? So Michelle, if you've got single family homes, you've got good practice, especially 5. That's not a simple thing. So hats off to you. I'm from Ohio. My wife's from Ohio too. We love Ohio. It's a great place for mobile home park investing. You could probably make that transition. Now, one way to do that is to be a deal finder and partner with somebody else with the money. Another way to do it is just buy a really small park and just test yourself running it. A small park would be, some people would say under 100 lots. I would say, maybe 20 or 30 lots. There's a lot of those in Ohio. And so that would be something to consider, Michelle. Another thing to do would be you could joint venture with somebody. So look for somebody who's experienced, joint venture with them. Maybe you find it, you do the management, they bring the money. That's something to do. So Verna Littleton says, do you think banks will continue to tighten lending in the next few months, even with more states opening back up and getting back to normal? Verna, a lot of people I really respect, we talk about the V-shaped curve, the W-shaped curve, the different shapes of curves for the economic recovery. A lot of people I respect think that there could be a W-shaped curve on the horizon. And so a W-shaped curve would be something that looked like, it went down, it had some euphoric improvement. By the way, Nikki, if you want to show this slide, you can. This is a V-shaped curve I'm looking at. And basically it says it's going to go down and it's going to bounce right back up. This is what we all hope and pray for, but it's pretty unlikely. A U-shaped curve is more likely, which means it's going to go down, have some rough spots along the bottom, and then eventually come back. That's more likely. A W-shaped curve is where it's going to go down, have a big bounce back this fall when things are opening up again, and then it's going to go down again harder. That's more likely, in my opinion, than an L-shaped recession is what we don't want to see. And that's a recession that goes down and then it just drags along the bottom for years and years to come, like Japan did. And so we don't really want to see that type of recession. It's a fool's errand to try to predict which one we're going to have. We just don't know. But in most of those, you're going to see, except for the V-shaped, you're going to see banks continuing to tighten their standards, have more reserve required, have higher credit standards, lower loan-to-value ratios. It's been pretty crazy for a long time. It's probably not a bad thing to have better standards, but it might make things more difficult. So hope that helps answer your question. So Katie, hi Katie, we're in Dallas, Fort Worth. Do you think we should look to invest somewhere else instead? Actually, Katie, Dallas, Fort Worth is one of the better markets in the US, which means it might not go down as hard as others. And so if you're looking to scrape the bottom like I am in Florida, you might want to look at somewhere else like Florida or somewhere else in the US. If you're looking just for something that's going to go down and then have a really strong, good recovery, then I think that Dallas Fort Worth would be a great option. Thanks for the question. Hey, Jerry Mills, what's your recommendation for 1031 exchanges? I did a call with a doctor yesterday and gave them 6 options for 1031 exchanges. So I should be able to remember at least 3 of those on a Saturday morning. Number 1, should a smaller investor use them? Number 2, is there a certain level one must reach before using them? No, Jerry, you can use them. A friend of mine just sold a fourplex, and I think he might be on here this morning. He just sold a fourplex in Columbus. I think he made $30 or $40 or $50,000 profit, and he used the 1031 exchange. So you can certainly use it. There's a lot of good reasons to use it, even if you're not a large investor. Now, I have lots of options on this, and Jerry, if you want to private message me, I can give you some. One is a Delaware statutory trust, which you can usually get in at $50,000 or more. That's if you have a total investment of $50,000. Other options I have are deferred sales trust and installment sale, which take $500,000 minimum. And then there are other options as well. So consider a Delaware statutory trust if you want to be hands off. One thing that's good about the Delaware statutory trust is you can go in now, and then maybe if they'll let you, you can cash out later and have that cash when this real estate market hits its bottom, I believe in 24 to 36 months. Manu Pathak, hey, welcome Manu, says New York and New Jersey remains very expensive for any property type. Yes. When do I think foreclosures rates will go down? Also, I have enough cash saved to buy in? Is that a good strategy? Yeah, Manu, I think it's a really good strategy to wait for foreclosure rates to actually rise. The number of people who can't pay their mortgage or chose not to in the last few months is something like 10 or 20 times what it was when things were good and rosy back in January and February and the world seemed normal. So, Manu, I absolutely believe foreclosure rates are going to skyrocket and you will have opportunities to buy. Keep that powder dry. And if you want to invest in single family homes, you're going to have great opportunities to do that. AI says, Paul, what are the cons and negatives for investing in a really small mobile home park, 10 pads? Well, you're not getting much economy of scale. If you lose 2 or 3 renters, it's pretty unlikely you'll lose 2 or 3, but that would be 20 or 30%. You're not getting diversification across a large group. You're not having the opportunity to add certain things, like you might not be in a position to add, things like cable and internet deals or a self-storage property you want to build onto, unless you have some extra acreage. Now, if you have 10 pads, one good thing about it is if you brought in 2 homes a year, that's 20% a year, at least the first year, that you're increasing the size of your park. And that is a way, in answer to my question earlier about not building from the ground up, 10 pads is a good start if you have extra land and you want to slowly increase it. The positives are you get to practice. It's a way for you to practice. Do you really want to own a mobile home park? Do you really want to run it? Do you want to find somebody to run it? It's a good way to get in. So AI, I hope that helped. And I hope that you could, I hope that if you find a 10 pad park, that you have great success in it. So Justin Kerstetter says, thanks for answering my question. Could you possibly connect me with your friend in Shasta County? Okay, he's not in Shasta County. I'm going to try to give you the name. So his name's Eli Weiner, Weiner. He's actually in Sacramento. And I'm trying to think of the name of his company. It's not coming to me Boa Vida, Boavida. Boavida. Justin, I hope that helps. I have no financial relationship with Boa Vida, by the way. I just know Eli. So, Butte Ween, welcome. Will the refinance rates ever get any lower? I don't think so. I don't think so. I mean, we actually are slightly higher than they dipped to a few months ago. But I think overall, this is the lowest range. I mean, is it possible interest rates will go negative and then we'll even see lower rates? Sure, it's possible. It's happened in Europe. So yeah, it's possible. I'd say it's unlikely. So let's see. Margaret says, I'm in Lower Fairfield County, Connecticut, realtor and investor, single family homes priced under $500,000 and investment properties up to 1 million are getting multiple offers if priced correctly. Did you see that, folks? Monday or Tuesday in the Wall Street Journal this week, they were saying that prices are actually going up right now. What? So I did a Bigger Pockets forum post and said, what is going on? And I got a lot of people replied and said, look, a lot of people are taking their houses off the market during COVID. So the supply has drastically dropped. Even if the demand is cut in half or whatever, the supply maybe is more than cut in half, and they're still getting multiple offers. Margaret, make hay while the sun shines, because I can't promise it's going to keep going. Here's my friend Tu Fang. What's the typical financing process for mobile home parks? How much down payment is usually needed? Are there agency debt available? Yes, there's agency debt. So agency, my friends, is SBA, HUD, Fannie Mae, Freddie Mac. Yes, there's agency debt. Companies like Berkadia, which is another joint partnership between Berkshire Hathaway and another group, they provide agency debt. I know for sure. The typical financing process is similar to everything else to down payment. You're going to want to see 30%. And of course, that could be, your money and also your investors' money. And is there agency debt available? Absolutely, like I said. So I don't know. I would say the best way to go for you too would be to find a St. Paul, Minnesota, regional bank, local bank, maybe check in with some of the folks there who do commercial loans, but I wouldn't go to a large national player. You can learn more if you go through the Mobile Home U training, Mobile Home Park University training camp. They have some recommendations on lending. Amy says, what would you do with $500,000 in cash right now? I flip houses full time and I own a couple rentals. Amy, I would say, if that's a track you want to stay on, honestly, I would probably not buy anything for a 5 or 10% discount, which you might be able to get right now. I would hold on. I would keep that powder dry and I would wait for amazing opportunities in 9 to 12 to 18 to 24 months. If you don't want to stay on that track and you want to get more passive with your $500,000, then there are probably other ways to invest your money. But I would imagine you want to stay in what you already know. So, okay. So I was here since your guitar solos a few weeks back. What? Okay. I do play guitar and I only played my guitar once on Bigger Pockets Live. And some people thought I was lip syncing or like I had a recording, but I really did play. But I don't play as well as Eddie Van Halen. So, okay. The Halloween episode was my favorite, LOL. Oh, okay. Thanks, Butte. Okay, great. So Nikki, what else? What else do we have here? I'll tell you, if we missed your question earlier, you're going to want to copy and paste it back in because it's gone for good on my screen. So feel free to copy it back in. We've got 6 minutes left till noon Eastern time. And so if you have any more questions, this would be a great time to ask. So mobile home parks, one of the things I like about them, just kind of wrapping up the thoughts on that, is we're actually improving America. Every time I write about mobile home parks on Bigger Pockets, I get really some one or two people being super negative, saying you're taking advantage of the poor, you're hurting people, you're going to raise their rent. Well, we don't. My company invests heavily in mobile home parks, and we do not invest with any operators who will do anything to hurt people. They actually are helping people. I've got a story this week alone. We closed on a mobile home park this Wednesday, and within one day, the manager was fired. It turned out he was an ex-felon, and the new manager was brought in. Some of the residents brought the new manager a cake. They were so grateful because within one day of this new manager coming in, they were getting water leaks repaired, streets were getting attention that they didn't have before. So by Thursday, within one day, the park residents were already so grateful. Their lot rents are $100 below market because they had a mom and pop operator. Well, will we raise them to market? No. Will we raise them a little bit? Yeah, but they're going to be thankful, and that's usually the case. Orange Juice said, do you think there will be massive defaults at the end of the crisis forbearance periods? Yes, I think there absolutely will be. Will banks really want to possess property in such numbers? No, they won't. What do you predict will happen? I predict that I and many others will set up a distressed debt fund. And if anybody wants to join us, if you have inroads to banks or servicers, special servicers, as they call them, that are going to have some of these assets, we would like to actually buy the notes before the property goes back to the bank. So we'd like to get like maybe 8 to 12 months in front of the foreclosure and actually buy the note at a discount from the bank and later possibly buy the asset from the bank. 6M Abbott says, do you recommend holding off on the purchase of any small multifamily in the Midwest? I'm in the PNW, but looking at Midwest. So you're in the Pacific Northwest looking at the Midwest. I mean, if I'm just going to be super honest with you, I'm holding off. I plan on investing in multifamily when this crisis shakes out in 12 to 24 months, but I'm not doing it now. So I guess I might as well just tell you what I feel and what I would do. So I hope that helps. Farouk says, what kind of return do you expect from mobile home parks? Generally a cap rate of 6, 7, 8% on the purchase side, which means 6, 7, 8% return on a cash investment. And then maybe an appreciation of an additional 5, 6, 7% as well. So a total return of 15% per year. Hope that helps. Hey, Brian, I own 9 single-family homes in Central PA, and I'm doing amazingly well. Congratulations. Sincerely, Brian. Hats off to you, man. Demand for single-family homes is high, so do I keep buying or wait for foreclosures due to forbearances? Seller financing. I'd wait. I mean, I would really wait. Brian, if you can wait, store up some dry powder, get some home equity lines on those homes that you have. Congratulations, by the way. Seriously, that's awesome. And I would actually highly recommend that you wait. The best deals. I mean, everybody I respect in this business, I can't think of anybody who doesn't feel this way. And I'm following a lot of them, people like Ken McElroy, who think that it's going to be the opportunity of a lifetime. Howard Marks, he's got a book called Mastering the Market Cycle I mention every week. He says he's raising the largest distressed debt fund in history to do what we want to do. Okay, we're wrapping up here in a few minutes, but right now, Brandon Tom says, I agree that now is a good time to hold cash. However, what do you think about spending money to do additions, garage conversions on existing rentals? The cost to build will be paid off in 2 to 3 years of rent from the additions. Okay, so if you have a 33 to 50% annual return from the additions, that is a great idea, Brandon. So I don't know if you'd be better off waiting till you can get a much, much cheaper deal, or if you should add those additions to the rents. I just don't know, Brandon, but I would say that either one is a good deal. I mean, if you can get paid off in 2 to 3 years, so therefore you have a 33 to 50% annual ROI, that is really hard to beat. Okay. So Wade Haldeman says, for Amy and her 500K, some of us are actually still working deals and acquiring, not soliciting, but I value my private lenders right now and show them better returns than they ask for. I believe in showing my appreciation for their trust and help me stay a bit more liquid. Okay, Wade, thank you. Great point. So there's other people like Wade out there who are looking for people who would loan them money and then they would do deals with it. So I think that's a great way to go, especially if it's fairly short and you can get in and out and get your cash back. So Farouk says, at how many rentals would you hire a property manager. It depends what asset classes. Okay, 17 right now, all duplexes. Farouk, if you've learned everything you need to learn from managing these yourself, I would forego the pain and give it to a property manager, those 17 units or 17 duplexes. The point is, and I always say, you should learn all you can yourself. Go through those pains, go through those midnight phone calls, calling those plumbers in the middle of the night. Do it first and then offload it to somebody else so you can spend your time doing something more profitable, like finding more deals, finding better ways to make money. Okay. Thank you, everybody. Thank you, Nikki. I can't believe that you let me do this. I can't believe I get to be here with all of you on Saturday morning. I appreciate you, appreciate Bigger Pockets. And we'll be back next week, same bat time, same bat channel, same bat place. And we can't wait to be with you again. If you didn't get your question answered, feel free to reach out to me. I'm Paul Moore, Moore, at Wellings Capital, and I'm here on Bigger Pockets. And I look forward to taking your questions and staying in touch. Thanks. Have a great, safe,